how earning too much money in your investments can affect your business's tax rates. Most Canadian business owners know how to grow their company, but very few realize how their investments can quietly increase the tax rate on their operating company. If you've built up a holding company with investable assets such as real estate or a growing portfolio, what happens inside that holding company might cost you thousands in extra taxes. Today, we're breaking down how passive income really works inside a corporation, how it affects your small business deduction, and strategies we use to help business owners keep their taxes low. Welcome to the channel. My name is Eric Silvaggi, and I'm an insurance advisor with Aegis Wealth Management, a part of Wellington Altus Insurance Incorporated. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help you reach your goals. If you're new here, please subscribe and click the like button. Business income versus passive investment. Let's start with the basics because everything builds off of this. Active business income is income from running your actual business through sales and services. It's eligible for the Small Business Deduction, the SBD, which is a federal and provincial tax benefit available to Canadian-controlled private corporations, also known as CCPCs. It allows eligible corporations to pay a reduced corporate tax rate on their first $500,000 of active business income each year. The federal rate is 9% instead of the general 15%, and the provinces apply their own rates and rules. This is the low tax rate business owners love. Passive investment income, dividends, interest, rental income, taxable capital gains. This income is earned inside your corporation from investments, not from your business operations. And here's the key problem. Passive investment income affects tax rates on your operating business, even if all the investing is done inside your holding company. The passive income rules and how they reduce your small business deduction. Canada changed the rules in 2019, and these rules changed everything. Here's how it works. Once your combined passive income across all associated corporations passes over $50,000 per year, your small business deduction starts to shrink. For every $1 of passive income above $50,000, you lose $5 of your small business deduction limit. At $150,000 of passive income, your entire small business deduction is gone, meaning your operating company income gets taxed at a higher general corporate rate instead of the smaller business rate. So even if the operating company didn't earn that passive income, it's affected because the rules apply to associated corporations, which includes holding companies. Why this matters to business owners with holding companies. Many of our business owner clients have built up significant assets inside their holding companies. It's smart planning. You move excess profits out of your operating company to protect them, and you invest those funds. These assets usually generate interest income, eligible and non-eligible dividends, rental income from real estate, capital gains from investments. And all of this counts towards passive income. More passive income equals higher corporate tax rates equals reduced small business deduction. This is why investment planning inside the corporation is different from personal investing. The structures matter. Strategies to reduce passive income problems based on CRA rules. Here are the strategies we often use with clients. Corporate class funds and tax efficient ETFs. These funds minimize annual taxable distributions, defer capital gains, reduce interest and dividend income. They help you stay below the $50,000 passive investment threshold, perfect for business owners who want long-term growth without triggering yearly taxes. Capitalizing on the capital dividend account, the CDA. When your corporation realizes a capital gain, 50% of that gain is taxable, but the other 50% goes into your capital dividend account. You can withdraw capital dividend account amounts tax-free to yourself as a shareholder, reduce future investment balances, prevent passive income from compounding inside the corporation. This can be a powerful way to intentionally reduce passive income your corporation generates in future years. Corporate-owned life insurance, a key strategy many owners miss. This is one of the most tax-efficient corporate strategies available, and here's how it works. Your corporation purchases a permanent life insurance policy. The cash value grows tax-deferred, no annual taxable passive income. When the insured passes away, the death benefit flows into the capital dividend account. The corporation can then pay a tax-free capital dividend to its shareholders. This accomplishes two things. First, it removes wealth from the corporation tax-free, and two, it does not generate passive income annually, avoiding a small business deduction clawback. For business owners looking to extract retained earnings efficiently, corporate-owned insurance is often one of the most effective long-term planning tools. Timing and managing realizations. Spread capital gains over multiple years. Trigger gains in low-income years. Consider crystallizing gains when passive income is safely below $50,000. This is about maintaining control over when income is recognized. Passive income inside a corporation can be a powerful wealth-building tool, but it can also quietly increase your tax bill if you're not managing it properly. For business owners with holding companies, real estate, or investment portfolios, the structure matters just as much as the investments themselves. If you found this helpful, hit the like and subscribe button and let me know in the comments if you want a deep dive into any of these strategies: corporate class funds, capital dividend account, or corporate-owned life insurance. We work with many business owners facing these exact challenges, and the right structure can save you a significant amount of tax over time.